It's all about the people. If you don't have the right skill sets to do that, to really have that control and run it properly, it's just not going to work. A lot of effort is spent on making sure that you do have the right skills, whether that's outsourced or not, when it's not somebody's main expertise.
Welcome to An Ounce of Prevention, the podcast. At R. Reese & Associates, we believe that an ounce of prevention is worth a pound of cure. Our daily commitment lies in informing our clients about legal risks without hindering their business objectives. As we like to say, we're in the business of building companies and helping executives sleep at night. So stay tuned. Maybe you'll learn something that'll help your business grow and thrive.
Welcome to An Ounce of Prevention, where we believe an ounce of prevention is worth a pound of cure. I'm your host, Rachel Reese. Before I introduce my guests, let's take a quick look at a recent case law update and break down what it means for your business. Today's update covers Abramowski versus Nuvei Corp, a securities dispute between Paya Holdings, Inc. and Nuvei Corporation, which was recently decided by the Third Circuit Court of Appeals. Here's what happened. In January 2023, Paya entered into a merger agreement with Nuvei. Under the agreement, Nuvei would purchase all shares of Paya common stock at $9.75 per share through a tender offer. However, under the merger agreement, all shares had to be tendered free of liens, restrictions, and encumbrances. Paya tendered its shares in response to Nuvei's tender offer, but Nuvei chose not to purchase them because the shares were earnout shares that were subject to transfer restrictions. Paya then sued Nuvei, claiming the SEC's best price rule required Nuvei to purchase Paya's tendered shares at the stated price. The district court concluded that the best price rule did not apply. Because the rule did not apply, the court dismissed Paya's claim. The issue on appeal was whether the best price rule requires the acquiring company Nuvei, in a tender offer, to purchase any tendered shares, even those subject to self-imposed transfer restrictions, such as the requirement that the shares be free of liens, restrictions, and encumbrances. The best price rule requires an offeror to pay any security holder for securities tendered in the tender offer the highest consideration paid to any other security holder in the same tender offer. In other words, the best price rule concerns the consideration that must be paid to tendering shareholders upon completion of a proposed tender offer. Paya argued that because it was a security holder subject to the tender offer, it was entitled to the share price paid to other shareholders. The court disagreed, stating that the best price rule does not require offerors to purchase every tendered share, even those restricted by prior agreement, but rather governs the consideration paid to shareholders. The best price rule is silent as to when an offeror must purchase tendered shares. Furthermore, securities law presupposes that a tendered offer may not be paid for and permits terms and conditions, such as Nuvei's condition that Paya's shares must be free of liens, restrictions, and encumbrances. The court concluded that because the best price rule is silent on when the offeror must purchase tendered shares, the merger agreement between Nuvei and Paya controlled. Under the agreement, Nuvei would purchase the shares only if they were free of liens, restrictions, and encumbrances. Because Paya's shares were not, Nuvei did not have to purchase them. The court affirmed the district court's dismissal of Paya's best price claim. So why does this matter? Many companies assume that once a tender offer is made, every shareholder is entitled to payment. Abramowski versus Nuvei Corp shows that this is not the case, and the parties are free to condition the purchase on whatever is provided for in their agreement. Bottom line, you need good counsel to draft the agreement and help you understand what you are signing. That's all for today. I'd like to thank Frances Warden, a law clerk in our Denver office, for her help with this update. Today I'm joined by Rebecca Stehle, founder of Aquaerial, a company focused on providing investment opportunities for oil and gas assets. Before forming Aquaerial, she worked at places such as ExxonMobil and ARC 57, which is a family office, and we're going to get into all of that today. So welcome to the podcast.
Thank you. I'm so excited to be here. Thank you for having me.
All right, so let's start a little bit of background. Tell everybody how you got to where you are today.
Rewinding, I got a PhD in chemical engineering in 2011 from Cornell and worked at Dow Chemical for a couple years and then moved back to Texas, to Houston, to work for ExxonMobil, and did that for about 10 years, always in a reservoir engineering role. And the latter part of that was focused on the Permian Basin. So I did asset management there, reserves, put the funding packs together for Midland County, and that was my main job there. And fell in love with unconventionals at that point in time. And in 2023, I had decided that I was really more of an entrepreneur at heart, and the big corporate life just wasn't for me anymore. So I left to when I found an opportunity to work for a family office after having looked at other potential options, investment banking, private equity. But I really enjoyed the flexibility and the creativity that came with family offices. It was kind of a choose your own adventure sort of a job.
Yeah.
So that's how I landed at ARC 57, and I really enjoyed my time there, and was mostly in a business development role, sourcing deals, not just upstream, really all different types of deals, but really kind of landed on the non-operated oil and gas space, and kind of built out a platform there of a lot of different AFE deals. We looked at over 100 deals, bidding on a lot of those, winning a good portion of those, and then, realizing that this could be a real business, and it was very exciting. And then at the end of 2025, I had just decided that I really wanted to put the accelerator on this, and
Entrepreneurial spirit
yeah,
again.
exactly.
Yeah.
And take it to the next level. So, just had agreed to part ways and just sort of run it on my own, which was a bit scary in the beginning. But then I did my first deal through Aquaerial in November and closed my second deal in December, and I've just been figuring out the backfilling of capital. I've closed both of those deals with all the capital needed, and back on the hunt for more deals. And it's been super exciting.
Okay, well, that is super impressive what you've done so quickly with Aquaerial, but I want to back up for a second and talk about ARC 57. So, family offices are so hot right now, right? They all want to do their own thing. They all want to start buying direct. Tell us more about what it's like to work at a family office.
It was a big difference going from a 10,000 person company to a 7-person company. But that aside, I think that the family office world, somebody once said family offices are like a box of chocolates. You never know what you're going to get. They're all different and unique and kind of do their own thing. There are, a couple common threads, one of which is that at least lately, the trend is to have more direct control over portfolio companies. And I saw that not just at ARC 57, but other family offices as well.
What do you mean by more direct control?
When investing in any deals, in terms of the governance in the document, just wanting to have as much, voting power and authority in a given deal, less likely to be an LP in a partnership, and more likely to be, try and go, be the GP or the manager, and either if they're raising outside capital or just outright buying a company and running it as a portfolio company. So in that sense, it's sort of like a merging of family office and private equity.
Right. They're taking all the things that they learned from being investors in private equity and now sort of doing it themselves.
Exactly.
Yeah.
Like the aha moment. Yeah.
So what does that really take? If a family office hasn't done this before, if they've only ever invested in private equity, and they say, you know what, we want to direct invest or we want to be the GP, what's that switch like?
Another big learning was that it's all about the people. If you don't have the right skill sets to do that, to really have that control and run it properly, it's just not going to work. A lot of effort is spent on making sure that you do have the right skills, whether that's outsourced or not, when it's not somebody's main expertise. For example, trying to get into a gas compression business when you don't have a gas compression expert or somebody who's run that type of business before. You really have to do your homework. And I think when family offices can partner very closely and have alignment with experts and specialists, things work really well.
Yeah.
But it's a tricky balance, I think.
Absolutely. I think that's probably why you saw family offices really start with minerals, right? Because it's an easier lift.
It's the ultimate passive investment.
Yeah. And now, then they went into non-ops. And now I know some that are actually operating. And I'm like, good for you.
Yeah. Yeah. And it's a progression because typically you don't just jump into operating because you have to really know what you're doing. But it's an evolution, right? After you've spent enough time around those other types of investments and you understand the language, and maybe going from minerals to non-op to operating is kind of a more natural progression.
Okay, so if I'm a family office and I'm thinking about making this change, what would you say some of the pros and cons are?
I would say the pros are definitely more control, definitely more equity. Obviously, if you're going direct, higher returns, but with that, switching to the cons, it's definitely riskier. If you are a family office that kind of wants to sit back and diversify and spread your chips and different things that you're not necessarily experts in, it's maybe not the best approach unless you're a really large scale family office that can have the staff to support that.
And I imagine the cost would be surprising too, right? If you don't realize that you have to have these outside experts, that you cannot just do it. The folks who were managing your investment before can't now be managing these properties without a lot of help.
Right. Exactly.
Yeah.
Exactly. And it's not just about the one-time investment. It's about the ongoing management of that investment.
Absolutely.
When you hear R. Reese and Associates, you probably think of a firm that brings value, insight, and service to the Texas oil and gas industry. You wouldn't be wrong in that assumption, but the reality is our expertise extends far beyond a single industry or state line. Energy is where we built our foundation. We've spent years serving operators, non-ops, mineral owners, and energy-adjacent businesses across the U.S., but our work doesn't stop at the wellhead. Today, it extends to renewables, water management, and energy tech. It supports companies as they scale, restructure, raise capital, or navigate mergers and acquisitions. And beyond energy, we work with manufacturing and industrial clients both domestically and internationally. Our expertise spans the full spectrum of business challenges, contracts, corporate governance, private fund formation, SEC compliance, and complex debt and restructuring. As those businesses evolve, so does our role. And this year, we've expanded again. RR&A now offers commercial real estate practice led by our Dallas office, and a dedicated estate planning practice headed up by our Denver team. These additions reflect how we think about client needs, because they don't exist in silos, but span industries, borders, and all stages of growth. So if you assumed RR&A was just a Texas oil and gas firm, think again. We're business-minded attorneys first, with the experience and perspective to support companies and industries across the globe, wherever they grow. To explore what RR&A can do for you, send us an email at podcast@rreeselaw.com.
Okay, so enough about family offices. Let's talk about you and what you're doing now. So you said you've closed 2 deals so far. Where'd you get the money?
For these AFE deals, typically you just, to close the deal, you just have to put up the cash offer, unless it's a carry deal, in which case you don't have to put up anything. And these 2 examples, I had just put up the cash offers myself. So that was taking on a lot of personal risk, obviously.
Absolutely.
But I felt very strongly and had a lot of conviction that these were really good deals. You put up the cash offer to close the deal, and then the bills for the drilling and completion come later. So the goal was just to backfill the capital before those bills come. And usually you've got roughly 4 months or so to do that by the time you get set up with confirmed pay status and all of that with the operator. That's essentially what I did. And, the war with Iran definitely helped the speed at which I could backfill the capital.
Oh, you're looking real smart.
Yeah. I obviously knew that was going to happen. So yeah, it all kind of buttoned up pretty nicely, and I was able to close those deals with the friends and family investors, and I'm on to the hunt now for more deals. Although it is tougher being a buyer at over $100 oil,
right?
So trying to figure out kind of what the long-term price outlook should be, relative to what it is.
Right. Yeah, everybody thinks that as soon as things go up, like everything's great for everybody. And it's like, well, if you already own it and it's flowing, sure.
A lot of sellers have backed off. There is definitely an inverse correlation between number of deals available and oil price.
Well, it's also the steadiness, right? So if we could say, hey, it's going to stay at 100 long term, great, those deals are back
Yeah.
on the market. They're just a different price.
Yeah,
right?
and buyer and seller agree
Exactly.
of what it is.
Right. Okay, what kind of deals do you like? I mean, aside from like cost effective.
Right now, I really love the AFE space. So just in defining that quickly, that those are non-op deals where the non-op seller basically sells their working interest percentage right before the well comes online. So you still get those PUD-like returns with a quick cycle cash flow. And that market has gotten increasingly competitive.
So competitive.
And I think if you're lean and mean, it's great. And if you're not, it's not great. That's where I am right now. I would love to get into the leasehold non-op space eventually when I have a little bit more patient capital available. And
So not well by well, but lease by lease.
correct.
Great.
Correct. Lease by lease, where it is still non-op, but the timing of when these wells come online might be 1 year, 2 year, 3 years. Unclear sometimes. But with that higher risk of timing, you typically get a much higher return. So I think that's an attractive market if you have the time to wait, basically, in the capital to to wait for that as well.
And the intel.
Yes.
Right? Is this
Yes.
lease going to get drilled or not?
Exactly. There's intel on the operator side. And depending on if there's geologic risk, there's geologic intel as well.
Yeah, because you don't want them to drill one well and be like, well, this whole lease sucks. And now we're just going to let it term.
That was a terrible investment. And then also, really interested in PDP non-op market because I think there's a lot of potential in wellbore reentries, particularly in the Midland Basin, as that's starting to, inventory is drying up. But that doesn't mean Midland Basin is over. They're going to go back into those wells. They are either going to refrac or do lateral cleanouts. And, if you have a clear picture of what that looks like, then you can make some pretty smart investments.
Well, absolutely. I mean, the Permian Basin in general, they've just been drilling, right? No one has had really the time or the desire to go back and work on these wells and see what else they can get out of them. But like you said, now that inventory is a bit low and prices are a bit high, probably time.
Yeah, and it's in some ways the best bang for your buck because just doing a lateral clean out is not nearly as expensive as drilling a new well,
or as risky.
Exactly.
Yeah. What about co-bidding? Do you like co-bidding?
I haven't done it yet, but I really like the idea because a lot of the deals that I see are really bigger than they should be, and what I mean by that is a non-op interest of, say, 30% might be available for sale. And one of the benefits of having a non-op portfolio is just having a diverse portfolio of small percentages. And in my opinion, having something like a 30% working interest is a bit too much to chew off for one deal. I tend to like to stay under that 10% working interest. But that doesn't mean that that deal is bad. It just means it's too big.
Right.
So if you can find partners that, in exactly the mechanics of how it works, who takes it down, how do you do the sharing, it's exactly, that those are details, I think, to be worked out between parties. But if you can split it up into, say 3 people split a 30% interest, I think those are 3 really good deals that are, smaller chunks, can add diversification to people's portfolios.
Yeah. And especially if you're the one sourcing it and bringing it to them and saying, hey, look what I found for us.
Exactly. But you have to take the capital risk to do that typically. Yeah, exactly. I think that's the best way to do it. It's just a matter of, are you able to do it?
Right. Okay. So speaking of capital, so you've done friends and family raise yet I'm not yet going to tell you the trend that I see happening with folks who've had a couple successful friends and family raises under their belt because I want to know what your next steps are.
It's possible that I'll do a couple more friends and family just to sort of build that track record. I would love to eventually have a fund, and that's kind of the end goal. But as one of the things I learned at the family office is that blind pool capital days are basically over. People, especially in Houston, where there's a lot of experts in oil and gas and they want to know what they're buying, are not interested in just the trust me story. Unless, they've been friends for 20 years or something like that.
Or you've got this amazing track record where you've done this a few times.
Exactly. So that's the idea, is to sort of build out that track record and then eventually transition to a fund. Obviously, moving from friends and family to include institutional investors, even if it's deal by deal, but larger deals, including wealth management groups and things like that, is eventually the goal. I think just to kind of grow that investor base over time.
Well, fantastic. So I will now chime in and tell you what I'm seeing, which is very close to what you were saying. We have quite a few clients who have been in the friends and family space for a while, or they're a family office, and everybody is ready to move up market, it seems, right? They all want that fund. It's not as hard as it used to be, right? I mean, the law firms. The law firms and the folks that can help you out with this, the tax advisors, they all know how to do it, and they're kind of churning and burning these at a great rate. It doesn't cost you $1 million to raise a fund anymore in fees. So I think we're going to see more and more of that in the space. Not only folks like you who were doing friends and family are now moving, but like family offices saying, okay, we'll be the GP and we're going to bring in other investors. So it's exciting times.
Yeah, exactly. And I think that there are a lot of people in Houston doing that because that's where the expertise is for the most part. And so what I've seen is a lot of effort to reach out to the Florida and California and New York investors.
Oh, interesting.
People that are formerly maybe heavy real estate investors, and then they say, oh, I didn't realize you could get 80% of your investment in year one back in tax deductions. So there's a lot of benefits that even if they may not be experts in oil and gas, but that they're really interested just from the tax perspective.
Any last thoughts for our audience?
I guess on that point, I do see a lot of people that are doing similar things that are touting the tax benefits, which are huge and awesome. But I think that what I like to bring to the table is that subsurface expertise. And you may have great tax benefits, but if the deal is not good, it doesn't matter.
There's no real economics to offset
Exactly.
if you didn't get any revenue from it.
Exactly. And I only like probably 10% of the deals that I see. And of those that I like and bid on, maybe only win 20-25% of them. But the ones that I win are really good. I think that that people that focus on the tax side, have to balance that with the subsurface.
Well, I mean, everybody gets the tax side, right? You need the subsurface if you want to be competitive.
Exactly.
Yeah. All right. Well, thank you so much. This has been great.
Yeah, thank you for having me. I'm glad to be here.
The information and material in this episode is general information about our practice and firm and is for educational and informational purposes only. This information does not offer specific legal advice, and the use of this information does not create an attorney-client relationship with RR&A or any of its attorneys. The information in this episode, or any episode of An Ounce of Prevention, should not be considered legal advice, and persons should not act upon this information without first engaging professional legal counsel.
Thank you for listening to An Ounce of Prevention, presented by R. Reese & Associates. If you found this episode informative, subscribe to, rate, and review our podcast on Spotify, Apple Podcasts, YouTube, or wherever you listen to stay up to date with future episodes, case law updates, and breaking news. If you have any questions or are interested in learning what RR&A's outsourced legal department can do for your company, reach out to us at podcast@rreselaw.com. That's podcast@rreselaw.com. Follow us on LinkedIn or call 832-831-2289.